US bond yields rose and US stocks fell overnight after robust US GDP growth figures reinforced views the Fed won't need to cut rates much. Now the focus turns to US inflation data tonight, and Australian job ads have dropped. That's coming up in our 5 Things in 5 Minutes on Friday, September the 26th. And then in our deep dive interview, ANZ senior economist Miles Workman reviews the New Zealand Treasury's long-term outlook for government spending released this week.
We say the long-term fiscal statement should be on every New Zealander's reading list because it is a document that is really designed to inform the voting public about these pressures.
But first, in 5 and 5 with ANZ, final GDP figures showed the US economy grew at an annualised pace of 3.8% in the June quarter. That was faster than expected, the fastest growth in 2 years, and more than the 3.3% initially estimated. ANZ economist Bansi Madhavani says this more robust data supports views from some at the Fed for only gradual cuts in the Fed funds rate, although others want much more.
Many Fed speakers are signaling emphasis on gradualism. Kansas City Fed President Schmidt said that policy is in the right place. His view is that inflation remains high while the labor market is still in balance. Even Chicago Fed President Goolsbee said that the Fed can ease further if inflation remains on track to come down towards the 2% target. We've also had some comments on the other side of the spectrum where Fed Governor Mirren continues to remain dovish. He assesses that policy is too restrictive at current levels, and he believes that Fed needs to act proactively, signaling his preference for series of larger cuts to reach the neutral level.
As of 4 a.m. Sydney Melbourne time, the S&P 500 and the Nasdaq were down 0.7% and 1% respectively after those strong GDP figures softened views about lots more rate cuts. The 10-year US Treasury yield rose 3.5 basis points to 4.183%. The US 2-year yield, which moves more in tune with expectations about the Fed funds rate, it rose 6.6 basis points to 3.664%. Gold rose 0.1% to $3,773 US an ounce. West Texas oil futures fell 0.2% to $64.85 US a barrel. The US dollar index rose 0.7% with those higher bond yields. That saw the Aussie dollar fall 0.7% to 65.34 US cents. And the Kiwi was down 0.8% at 57.65 US cents. Number 2. Attention now turns to US PCE, or Personal Consumption Expenditure inflation data for August. That's the Federal Reserve's preferred measure for inflation in the United States. Bansi sees headline inflation rising 0.3%, but core inflation a bit softer at 0.2%.
Such an inflation report would support the view that price rises on the back of tariffs are likely one-off, and there is no broad-based rise in prices of all goods and services. At a time when Fed members are worried about elevated inflation, we think such a report will be encouraging. So long as inflation impulse signals that disinflation trend is intact, we expect the Fed can continue to ease in gradual increments of 25 basis points.
Number 3. Australian job vacancies fell 2.7% in the 3 months to August as traders look for signs that the RBA would be able to cut rates again after stronger inflation last month. Here's ANZ economist Aaron Luck.
The result was driven by a 3.4% decline in the private sector, while the public sector actually rose 2.2%. 11 out of the 18 industries saw declines in vacancies, and the largest declines were seen across the professional services sector and construction sector as well.
Number 4. Aaron says the release showed some signs of pressure coming off the labour market, something the Reserve Bank of Australia would be taking note of.
It actually showed the ratio of unemployed persons to job vacancies rising to 2, and that's actually the highest level since early 2021. And that's more evidence that the labour market is beginning to ease and we are actually moving closer to full employment. Look, at this stage, we're still expecting the RBA to cut the cash rate in November. I don't think that the labour market will be a deterrent for them not to go.
Number 5, the Bank of Japan's July board minutes showed that while policymakers voted to hold rates, several of them pointed to a desire to keep normalising policy in the future, which means putting them up, including this year. Here's ANZ FX analyst Felix Ryan.
And the dissent is still definitely not the majority, definitely a marginal view. And there were only 2 dissented at the meeting. Most members seem to agree with the view that there was a need to wait longer to know the full impact of tariffs on the Japanese economy from the US. So overall, there is a divide, yes, amongst policymakers, but the dovish or cautious view still prevails for now. So that does underscore our view of no more rate hikes from the Bank of Japan until January next year.
Felix Ryan there. Now, in our deep dive interview, ANZ senior economist Miles Workman explains why he thinks every New Zealand household should read the Treasury's just released long-term fiscal statement.
The Treasury is required to produce a long-term fiscal statement every 4 years, and it's designed to show where future pressure points are on the fiscal position. So this is a statement that looks out about 40 years to tell us what our fiscal future might look like if we were to maintain current fiscal policy settings for that whole period of time. So at the end of the day, the fiscal statement is really designed to tell the public and policymakers where these fiscal pressures may be coming from, so we can hopefully do something about them before they become too painful.
I mean, New Zealand, if you look at it on a sheet of paper against other nations, you could argue it's got low debt, a strong credit rating. What worries sort of appear through the long-term fiscal statement, and how quickly could these become reality?
So the Treasury's modelling shows that the ageing population is the elephant in the room in terms of pressure on the fiscal position, with the two types of models they ran basically suggesting that if we do nothing, debt to GDP is going to lift to about 200% of GDP. Now, that's not possible in the sense that by the time we get, well, by the Treasury's estimates, sustainable debt levels are about 50% of GDP. And once you start to breach those levels, you'll really start to struggle in terms of issuing the bonds required to fund the government's activities. And ultimately, if we are wanting to fund that level or those high levels of debt, we end up in a situation where we have to give investors very, very high rates of return so that we can borrow that money from them. And then ultimately you get that funding cost, which will just put so much pressure on the tax system that all of the taxes that the government's collecting is just going to these investors to service this high level of debt, and government services have to fall on the other side of that. So look, the cost of doing nothing here is just simply too large to imagine a world where politicians do not adjust. They will adjust because these pressures will require it. The question is, how are they going to adjust and when? And ultimately, the upshot here is that there is no free lunch. There's no costless solution here. You do nothing, it's very costly. You wait and kick the can down the road and do something very last minute. A sharp adjustment is costly, or we could probably do something that has an overall smaller cost by making gradual adjustments, but doing them early.
So the Treasury's put this warning out there. Has it made any suggestions about how to make those adjustments and when to do them?
Yeah, so the key conclusions here from the Treasury are the sooner you start, the better, because it should reduce the overall cost of adjustment. They focus on things like superannuation reform, but also other expenditure restraint, tax reform as well. So whether that's higher tax rates for income earners or broadening the tax base through a capital gains tax. But the good news here is that there are plenty of options on the table, but what is difficult is the political appetite to do these things. Of course, politicians don't like doing things that the voting public are against, and that makes it very hard to implement these types of policy decisions. And that's why we say the long-term fiscal statement should be on every New Zealander's reading list, because it is a document that is really designed to inform the voting public about these pressures, so the voting public can understand that these are on the horizon. There are costs no matter which way you approach it, but let's just have a conversation here about hopefully doing something earlier rather than later.
Now, a lot of the focus has been on these costs in the future and those high debt levels, sort of 10, 20, 30 years' time. Are there or could there be any implications for, say, the DMO bond issuance now or in the near future from a report like this?
So when it comes to bond issuance, that's always going to be a function of government policy. So the Treasury's report is independent from government policy. You wouldn't expect near-term bond issuance to be affected here unless the government started to react to the recommendations in this report.
Miles Workman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, September the 26th. Catch you next week with detail from tonight's US inflation data and what it could mean for US and global interest rates. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.